Good day, everyone. Well, we've got a market that refuses to roll over. We have central banks, as we know, printing money in unison. The Fed has joined into the fray, not in printing more money, but in backing off on its 4 rate hikes. They reduced that number to 2 rate hikes now for this year. And my guess is that with the global economy stagnating and it should continue to stagnate because all this money printing business and negative rates are not helping. If anything, they're going to be hurting the economy. So the Fed can paint these statistics as any way they wish, with the low unemployment rate and the low CPI numbers. But the fact remains that there's so much evidence outside of the U.S. that the world is not well. And there's been interesting charts going back many hundreds of years. I love to study going back. Well, I thought I was the market historian going back hundreds and hundreds of years, but Mark Armstrong is completely throttled back by going back thousands of years. And I love reading some of his writings because it's a great history lesson for me. And I can then go to Google and make sure that what he's saying is actually true. So it really rounds out my learning. But I bring up the last 100 years because there have been charts that show economic correlation between countries. And what's interesting to note is that going back all the way to the 17th century, or even before that, like what you'll see is that when one or two major countries catches a cold, the rest of the world does too. Sometimes it's pneumonic, sometimes it's beyond recessionary, and so it's fascinating to see that despite the technology that's in place today, certainly in the 17th century we didn't have much technology to speak of, but yet we had some connectivity between nations, such that the global economic correlation among countries was very pronounced. And that's never changed. I mean, it's probably become more pronounced today than it did then, but there were high levels of correlation then. So for the U.S. to say everything's fine or things are getting better, when the rest of the world can't say the same thing, I think shows who's the liar. Because certainly the U.S. can't just pull out of this problem on its own. Everything is connected. It was connected in the 17th century, and it's even more so connected today. So with that said, with all these central banks doing what they're doing, it's not terribly surprising that we're seeing a continuation of this bounce. The saying "don't fight the Fed" certainly applies in multiples when you're talking about Fed, or rather central banks, various forms of Federal Reserves across the planet. And the question is, of course, the lack of confidence that continues to grow. We saw evidence of that last year. We've seen it this year. So as the markets attempt to reach new highs, the S&P, for instance, is only 3% off its peak. It calls into question whether we can just continue moving higher. The QE program that started in late 2008 certainly manipulated markets higher. It's done so since then, and so one could argue that if this market continues higher, like it's showing itself, then it's possible you could label this as the well, I guess this would be the 8th year of the bull market that started in 2009. And that certainly is a very aging bull market. At the same time, it could be said that the major market top was put in middle of last year. And that doesn't mean, of course, that it has to play out to a catastrophic bear market where major indices drop by more than 30 or 40%. I believe that's going to happen, but the central banks doing what they're doing can postpone that inevitability. Maybe you can postpone it for another year. My gut says that because of the technical action we've seen and because of the lack of leadership in this bounce, which has led much by the defensive names. The Dow Jones Utility averages have been the champ in this rally. That tells me all is definitely not well, and I do question how long these central banks can manipulate markets higher in this kind of straight line. I wouldn't be surprised to see a repeat or run of some sort from last year's script, where markets just can't seem to find direction. And that's, markets don't like to repeat, but as Mark Twain said, they often like to rhyme. So I think that's going to be the tug of war going forward. It's, and prior, as we've seen, is basically the central banks versus the growing lack of confidence in governments. And that calls into attention gold, which is, has shown a pronounced move off its lows. Gold represents a lot of things. It's a fear trade, so when there's lots of confidence in governments, people rush into gold. When the market tanks, as it did, people can rush into gold. It seems to me that the rise in gold may not be over, especially if the lack of confidence becomes more pronounced.
Hey, Dr. K.
So markets, yeah.
I've got one point I would make, and I wouldn't assume that the move in gold is all because of fear or lack of confidence. I mean, what about just the dollar? The dollar continues to dive, and
sure.
we know from 2011 and when gold had a huge move that can be the sole driver, and that's a valid driver.
Yeah, sure.
So I definitely think it's a playable rally. But I just wanted to point that out, that I think it's more due to the dollar declining. So.
The price of gold moves on so many reasons, as we've cited before. It has lots of cross currents, which is why it's very hard to predict its direction on a fundamental basis. There's many things that are multidimensional that one is liable to overlook. Simply the data might not be there, but does exist behind the scenes that drive the price higher. I mean, the Chinese, for instance, quietly buying up gold in years past, which puts a lot of buying pressure on the metal. And of course, the movement of the dollar. We wrote just the other day that the dollar is weakening out, and so that causes gold to rise again because of the Fed's more dovish stance that they're taking. So, but what I find most interesting as far as moves in gold, there's many reasons, but the most interesting reason to me is lack of confidence or loss of confidence in governments, and because going forward, I think that's going to be a major variable as we're sitting on the 39th day, as well detailed in Ed Sekoda's book of Monopoly, and of course that in a reframe of very negative news events. I mean, every day there's major news headline items that hit my screens that this has never happened before. I mean, the pronounced number of news events around the world that continue to accelerate and increase social unrest, and all these situations that just taken alone would have been a major news item, say 10 years ago. But it seems like they're really aggregating now, and as Ed Sekoda talks about, this trend is going to accelerate. So the more I see these news headlines and ludicrous news events that are actually happening, it actually, in the long run, makes me feel better, because I know we have to go through this vetting process. Things have to go from bad to worse before they're going to get better. And as Dakota says, there's nothing anyone can really do about it. It's too late, it's at this stage. But what one can do is keep a clear head and watch for the turbulence as it arises. We are going to have some tsunamis on the way, and volatility is a great time for profiting. So that's we keep watch at our posts for the next great wave. And at any rate, markets continue higher as I speak. And I will turn it over to Gil at this point.
Yeah, I would make one point to everybody, and that is that what I think you should focus on is the price volume action of stocks. So, and I don't really see that there's an issue with a lack of leadership. I actually see a number of stocks acting pretty well and providing leadership to the market, but in a way that's different from the standard CAN SLIM way of looking at things, which I think is a very narrow an irrelevant system these days. Yeah, I know some people get upset about that, but to me that just means that you're stuck in a rut and you can't expand or evolve your thinking beyond some simplistic rules that somebody shoved into your head. So I do think that there is some leadership popping up. I mean, I'm just going through my names this morning. I noticed here's a breakout. These little here's 5 below. Also, these little discount retailers seem to be doing well, which thematically would make sense if we're in a weak global economy. But you're also seeing a lot of ugly ducklings come to life, and we know from prior QE rallies that the primary movement comes from stocks rounding out new bases, and we picked this one off relatively perfectly on a pocket pivot coming up through here. Hey, Dr. K, I got to answer the door real quick. Can you just sort of discuss this stock? I'll be back in like 30 seconds.
You're on ALT right now. Yeah, sure. So we've got a stock that's got fairly strong fundamentals, being an airline stock. It's had a double bottom of sorts, came up through its major moving averages, and it had a pocket pivot the other day, a little over a week ago. Fundamentally, it's looking pretty strong because as earnings are accelerating, and we see it's trying to approach new highs. The whole thing, of course, in this market is that you don't want to be buying on strength. You want to be buying on pullbacks. I was just saying, you don't want to be buying on strength. You want to be buying on pullbacks. The fundamentals on this company look good, etc.
Okay. Hopefully we don't get too much noise. We got some guys here putting some new woodwork on the awnings here at the house. So that's the beauty of owning a home. You don't own the home owns you. And maintenance and upkeep is something that people don't think about when they wedge themselves into a house. But anyways, hopefully they don't make too much noise as they're banging around. So you got Alaska Airlines. Look at some of these other airlines. Love coming around. They're all coming around. So see, while people lament the lack of base breakouts and so-called leadership, I mean, leadership is as leadership does, not whether it's just breaking out. So in my view, you've got all these stocks that were leaders previously coming around and browning out bases. So you got this one, Hawaiian Airlines, remains a leader, moving higher. Look at First Solar, a less orthodox position, because if we look at it here, it's coming out of this sort of cup with handle formation, but it broke out and you had a pocket pivot here 3 days ago. You can see that. Let's look at a name like NVIDIA. Somebody emailed us yesterday and they pointed out that there was a pocket pivot here. Stock was pulling back and I emailed them back and I said, yeah, that's a pocket pivot. If you want to buy it, you can buy it. And it's a little V-shape on the weekly chart, but it's breaking out, and so there's a leader for you.
Yeah, MXL is its cousin, which we report on.
Yeah, and that's
overall, it was just slightly better in terms of fundamentals combined with the technicals. But there's nothing wrong with NVIDIA. But as we always try to, pick the best. So out of those two, we felt MXL was more. But
yeah,
again, it's splitting hairs.
And yeah, remember too that we're into teaching people how to fish. We're not here to hand you a fish. And so if you see a pocket pivot and you understand the story behind the stock or the impetus for a price move, then I think you can go for it. Don't rely on us. Oh, hey, Dr. K, real quickly, there was a question here. What was the name of the book that you mentioned in your previous discussion? Was that Wall Street? Pardon me?
Gavopoly by Ed Sekoda.
That one. There's another really interesting book, if you can find it. It's called The Wall Street Waltz, and it's a book full of charts going back to, I think, the 1800s of the markets and the economy.
Actually, it's funny that I was mentioning about the economies correlating, and that was one of the charts that came to mind. They have an excellent chart going back hundreds of years.
So
it's a great book for providing a 50,000-foot view.
So the two books are Gavopoly in the 39th Day by Ed Sekoda, and then The Wall Street Waltz, which I don't remember the author of that. But in any case, so let's keep going through some of this. Here's another one, Smith & Wesson. This thing is broken out and it's moving higher. It hit the $30 level today. That's probably indicating it needs to pull back, but that's leadership. Let's look at Facebook. You know, Facebook's trying to break out. That's actually forming a neat little pattern here, and it's moving higher. The volume isn't there, and this sort of, I got an email from a friend who's an engineer, and he likes to model the market in stocks, you know, so he creates these massive, beautiful looking colored spreadsheets with all this data on them showing various stocks, but he's totally frustrated right now by the fact that he can't seem to get a handle on leadership. He was complaining to me about Facebook, that it keeps moving higher and the volume is low, and I said, yeah, because nobody's selling it. So stocks can go up by virtue of nobody selling them just as easily as they can go up by big buyers coming in. And in a rotational market like this, where you maybe have very little in the way of secular inflows into the market, I think that's the phenomenon you had. But one thing I would note, and I was studying Facebook over the weekend, this past weekend, is if you look at the sponsorship, Fidelity is a huge holder of the stock, but right now they have about a 5% position overall. And I remember when they believe in something, because they were a client of ours back when I was head of institutional services at O'Neill. You probably remember Dr. K. They were a big client, like the biggest client, I think.
Oh yeah.
And a lot of smart people there, but they actually were buying Facebook in the last quarter of 2015. So they're buying into pullbacks. They own about 5%, and I know for a fact that, especially Will Danoff, who runs a contra fund, and now you see Will, he's on, well, you don't see Will, but you see all these allusions to him, people writing postcards or letters into Fidelity, and he tapes them up on his the glass wall in his office, I guess. But he's become a celebrity, and he started out as a retail analyst at Fidelity way back when. But now he's like he's their new Peter Lynch. But in any case, I know that will come in and buy 10% positions if he has a lot of conviction. He did that with Apple in 2004 and held that and didn't really start cutting that position back until 2012. And if you go back and you look at the institutional ownership records, and you can check it on Yahoo Finance, you'll notice, and you have to keep track of it also, you'll notice that they did unload some of their Apple back in 2012, and they cut back their position fairly significantly, and that sort of marked a big top in the stock. So they maybe have bought it back, but I'm guessing that the recent weakness in the stock probably was other funds in losing the position as it gets to a point where it's finally done and the cycle ends, at least for now. Now with Facebook, you have a stock that has never really gone parabolic. If you look at this weekly pattern, it's been very clunky and chunky all the way up and just kind of trucking its way higher, but it's never really had a big move. And if you study the sponsorship, you know that a lot of big funds own positions in it, but they could increase those. So my point with Fidelity is that even though the FMC altogether, that's Fidelity Management Corp, has about a 5% position, that could rise to 10%. And in the process, that would drive Facebook a lot higher. And it hasn't really had a big move. So my feeling is this thing is buyable definitely on pullbacks. The 10-day line is now at 109.20, which I think is going to provide your lowest support point. But I think the top of this little consolidation we've seen over the last, say, 3 weeks is 110.55, I believe. Yeah, so that probably becomes an area of support. So it's coming in today, and I'm buying back some of the position I sold up in here and adding more and getting heavier in the stock. So actually right now I have about a 70% position in Facebook. And my feeling is if the market's going to go higher, this is the big stock that will go higher. So I'm going to ride this one. The way I trade, I need to be able to buy big liquid stocks in size and be able to move quickly in them if necessary. So I'm taking a position of a bullish position on Facebook, thinking it should go higher, but if it doesn't work out, at least I have something I can get out of very quickly and very easily in this market, which is not necessarily all that easy. Somebody points out Wall Street Waltz is by a man named Ken Fisher. Is that the same Ken Fisher with Fisher Investments? So somebody here makes the point, has the central bankers lost control? BOJ and Draghi are trying to cheapen currency. Both are up on your what's up with that. I don't know. Why worry about it? I did hear a quote, or I read a quote from Mario Draghi this morning where he said that printing money it isn't addressing the root of the problem, which is structural. and that reforms need to be made on a political level, which would be tax reform, tax decreases, other increased public and private investment. And I think low interest rates don't help that out because nobody wants to save money, and so you're not increasing the capital stock. Remember that after World War II, well, probably most of you don't remember, neither do I because I wasn't alive then, but I've read about it. And Bill O'Neill told me that after World War II, a lot of people were saying, economists were saying, oh, all these GIs are going to come back, GIs being soldiers, going to come back from the war, and there's not going to be any jobs, and there's going to be unemployment, and it's going to be a big burden. What actually had happened during World War II, since nobody could buy anything, they were saving their money. I mean, my parents tell me about putting cardboard in their shoes because you got ration coupons for buying shoes. And so people were forced, they couldn't spend, so they were forced to save money, and there was this pent-up demand as well as a huge stock of savings being built up by individuals, by households. And so that was unleashed in the 50s. Now you have the inverse of that, which is low interest rates are sort of destroying the capital base. So I think that needs to be reversed. So I think a lot of people like to criticize Mario Draghi, but I think he does understand what needs to happen, and I think that's why Mark Faber, people might know Mark Faber, the noted Swiss economist. He publishes the Doom, Gloom, and Boom report. He's always fun to watch, but he's actually endorsing Trump because he sees him as a disruptor, and someone needs to disrupt all the BS that's going on that I think Dr. K discussed earlier, and just sort of shake it all up. Because the Republicans have been in power in the House at least since 2010, and all spending bills originate in the House of Representatives. So they've been in charge of the House since 2010, yet the total debt has increased about $5 trillion during that period. So they're not going to change it. So anyways, you need some disruption. And I wouldn't get hung up on indignance over what central banks are doing and whether they're abusing their power, or pushing on a string, or flipping a yo-yo, or blah, 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 whatever. Just watch what the stocks are doing, and you'll get a sense of what's happening. And I know it's an easy trap to fall into because I've done it, and I did it in 2009 when I was reading banks' 10Ks and 10Qs and looking at their balance sheets and realizing that these guys have so much in bad assets, they've got to go to zero. And of course, that turned out to be a fatal assessment. And I think you can't let any of this cloud your mind. So it's just clutter in your mind. It's noise. And just forget about it. Focus on what the stocks are doing. So let's look at some of these. I've got a position in Splunk right now. And that has had, this is another ugly duckling situation. It's a little V-shaped. We were talking about this last week, but what I noticed is it holds tight along the 10-day. And I like the action yesterday, the last few days along on these pullbacks. So it's starting to move higher. And I think you go to the 200-day. But this is another ugly duckling setup. Okay, and most people who are CanSlim cult members won't see these types of setups. Here's Mobileye. It's another one I think has been on a comeback, but it's a little V-shaped, as I pointed out last week. But it doesn't mean they can't go higher, because I've seen this sort of thing happen many times before, where you think a pattern is weak, but until you actually see bona fide weak action in the stock, it can go higher, and a lot higher than you think. So I know that much. I know. So look at something like a Solar Edge. Now this is hanging out in a base, and if we look at this, we've talked about this for a while. I think this has potential for a pod sort of move up the right side of this big cup, and it's taken some time, a fair bit of time, almost 3 months now, to consolidate sideways, which the move off the lows. So I think I pointed this out. You see supporting weeks in here. Here's obviously a big up week here, and then you move along here, and you see a big up week where you close in the upper part of the range. You see a big up week here where you close in the upper half of the range. And last week it came off a little bit, and it's holding along the confluence of the 10-day, 20-day, 50-day, and 200-day moving averages. So it's hanging in there. Now, in this market, I think this illustrates the sort of creativity you have to implement if you're going to try and find spots where you can buy stocks. And I don't think you ever want to be chasing strength. I think you want to focus on strong names that have shown prior strength, but which are consolidating and pulling into areas of logical support. And that's kind of a broken record for most of you, unless you're a newbie here. But you can see how this one, and if you get a sense, I've watched this thing trade for a long time, and you get a sense of it just kind of flopping around. Whenever it starts to break, it does find support along the lows here. It has. Now you made higher lows and higher highs. Notice here, though, you undercut this low earlier in the week. Those have been Tuesday and Wednesday. And you undercut the lows, but you close near the upper half of the range, or actually pretty close to the peak of the range. On both days, this volume is declining. So when I see something like that, I'll come in and take a position on this with the idea that I can use a low here to get out quickly and then rethink it. So I take a very flexible approach, and that is I'm trying to buy on weakness, but I'm also ready to blow out of it if it doesn't do what I think it's going to do. But then taking it a little bit further, if I do blow out of it and it sets up again somewhere, I'll come right back into it. And I may come back into it a little higher than where I sold it before. And that's the way I'll operate. And I don't need to really get caught up in the whole overthink of where I bought it. No, I can't buy it back higher than where I sold it. Oh, sure you can. I've done that many times in my career. I bought and sold Apple many times back in 2004 at around 36 bucks. And then at 43, I bought 500,000 shares, and the thing took off for 90 something by the end of the year in 2004. So, you know, it's not where you buy it that matters. It's buying at the point where it's potentially going to have a big move, or at least a move that's significant enough for you to make some money. So give me 1 second. I'm going to close the window here.
Yeah, I would continue by saying, you know, those are some of the most difficult trades to make, is when you get whipsawed out of a position, and you know, so you might be emotionally engaged in that particular stock, and then it signals another buy point, and getting back in can be something tough. But in my experience, those are some of the biggest winning trades, is just being able to get back in. In fact, Sekoda told me a story years ago saying about a coffee trade. He said he had to trade that 5 times in a row inside of a year, each time losing money because he kept getting whipped out of the position. But the 6th time he traded, that's when he made his huge killing. And he said that's what separates him from the majority of traders. And so that lesson stuck in my mind. You know, because that will happen, and sometimes it can happen in the best of names.
Yeah, and they'll try and shake you out and fake you out. I think Facebook's doing that right now, but if you look at the pattern, you know, that the pullback here is normal. I always think it's interesting. You see a stock go up 1, 2, 3, 4, 5, 6, 7 days. Well, 6 out of 7 days in a row. And then yesterday it pulls back, and then I start hearing people either tweeting me or elsewhere emailing me that, oh, what's wrong with Facebook? And why is it nobody thinks something's wrong when something's going up? It's only wrong when it's coming down. And I think yesterday it was down about 1%. So that's really not very much in the grand scheme of things. So also keep the pullbacks in perspective. So if you're trying to sit with a smaller position on a pullback, don't get freaked out by pullbacks of 2 to 3%, unless you're starting to see something break a support level on pretty heavy volume. So somebody says, can you discuss RS line confirmation? I don't pay attention to the RS line confirmation. I know that's what the Can Slim types like to focus on, but I don't worry about the RS line confirmation. I can tell you something from when I was working at O'Neill in 2003. One of the problems with we used to use a 12-month relative strength line, and that was showing divergent action, in that you'd see a stock moving higher, but the 12-month RS line was lagging, and so you weren't getting this RS confirmation. So we started using, and it's actually the first time that we calculated and put as a data item on Wanda a 3-month and a 6-month relative strength. So I pointed out to Bill that if you look at a 3-month relative strength or a 6-month relative strength, you'll see that that's actually acting better, or better confirming action in that based on you know, the movement of the stocks. And I think a lot of that was due to the fact that 2001 and 2002 was a brutal bear market, and a lot of stocks were coming up off the bottoms of patterns. They had spent enough time so that you could look at them as new bases. Things like Amazon, I remember that had a big move, eBay, etc. So, you know, again, over-reliance on a single data item or something that I think is old and not working, because ultimately price and volume, and then someone argued that just price alone is all you need, are really the ultimate arbiters of where something is going. You know, looking for confirmation, all this other BS, to me just means that you're dependent on an old way of looking at things. So
yeah, also if you become good enough at improving your chart eye, you don't need that relative strength line. I certainly never used it in the late 90s during the go-go years, and I just never found it to be useful in my trading in general. I do know that a lot of the guys who are pretty good at it, they do use it. So I mean, again, it's another tool that maybe you can make useful for your trading, but I don't think it's entirely necessary. And I do like Bill's approach has always been to keep it as simple as possible. So if you don't need to use an indicator like that, then you're better off.
yeah, and I wouldn't get hung up on one. But yeah, another thing too is if you notice that something isn't that effective. So in other words, you're seeing something in the relative strength line that doesn't explain why a stock is moving higher. Well, what's that telling you? That there's something wrong with the stock, or there's something wrong with the relative strength line? It's telling you there's something wrong with the relative strength line. It's one of the reasons I prefer to use HDSI these days, and I don't even look at an RS line. I look at stuff like, I'll show you this. They put this out finally the other day, and this is a chart. It's showing volume at price for the last, using 30 periods and 90 periods. And it shows you two charts. So this one is for 30 periods. This is for 90 periods. So this is for Facebook. Now, I don't know if you, let me see if I can blow this up. But this is very useful, and I find that it can be helpful in determining when a stock is breaking down or when it might be recovering, because you'll get this this point of control is what they call it. It's the blue line here, and that will show you where most of the volume has traded. And a lot of times that's either significant support. You see in the pullback here it was. You can see once Facebook got above the 30-period line, it's finding support on the pullback here, and once it got there, it's moved higher. So I think a lot of this stuff is useful, and I like the idea of having a system or a software program rather that has a number of indicators and a number of ways and chart views of looking at the market, because when something in the traditional O'Neill sense doesn't work anymore, well, you've got to find a new way to look at the market. If you sit there beating your head against a rock, guess what? You're not going to have much left in the way of brains, because they're going to be splattered all over the ground. So, wake up and go with the flow and learn, how to ride the waves rather than deciding that there's only one way to do it. And if it doesn't work that way, there's something wrong with the stocks, when in fact it may be wrong. There may be plenty wrong with the method, okay? And I know some people don't like to hear that because people get comfortable and they don't really want to think for themselves. But that's the reality of the market. If you're not willing to accept that, then I think you're not going to be successful. And that's why in this market, you're looking for traditional leadership. I think it's starting to show up, but it's different. The setups are different. Here's an ugly duckling setup on Cyber. Finally, okay, I got to admit, I took it off my buy watch list here, and of course it does one shakeout. So I think on Wednesday I was sitting there, oh, look at that piece of garbage. It looks like junk. But look here. It undercuts the lows, closes near the peak of the range. It looks a little bit like the way Sedge act, Solar Edge, a couple days ago before it pushed higher. And now the stock is jamming to the upside. That's one of the reasons I like Splunk also, is that you're seeing names like Palo Alto Networks trying to set up, Fortinet even trying to come back a little bit off his lows. FireEye is another one. Checkpoint is another security. It's considered a cybersecurity name, but Splunk has signed agreements with all of these major cybersecurity names like Palo Alto Networks, like CyberArk, like Fortinet, etc., where they're incorporating their software into their security system. So it is a security play, and the fact that it's able to act pretty tightly along the 10-day line, I think it can go higher up to the 200. So I'm willing to play these, and you're seeing them all over the place. And this is very typical for a QE market. So we already know that in a QE rally off the lows, you don't get breakouts. You get ugly ducklings and roundabouts and bottom fishing pocket pivots, and that's where your best moves come from. So, sitting around trying to buy breakouts or waiting for breakouts probably means you're going to be late. All right, let's see. What else do we got here? I'm looking around. What would I be buying right now? I notice, is it FN? That's it. Fabrinet. This guy's, I hate this stock mainly because you had a Bible gap up, but it failed. So it would drive you out. You get big volume, it hits a 50-day, looks like it's going to break and bounces, and now it's trying to set up again. But it's a thin stock, trades 377,000 shares a day. Okay, we'll give it 378, but still pretty thin. And its cousin is Lumentum, which has been holding up a little bit better. But look at this spin out. Dr. K, this is sort of typical for thinner stocks like this, right? Where they can have these random spin outs and then just kind of right themselves or proceed higher.
Yeah, that's been true in the QE environment since 2009. That's why the thinner names have been a lot more vulnerable. I don't know if that's QE or just the way markets are made. Something is changing the way markets are made that make these smaller cap stocks much more vulnerable to major price swings, very sloppy price swings. And I've seen that in more than a handful of names over the years.
Yeah, and that's one reason I don't really traffic in those sorts of names. So let's look at some others. Here's WebMed. Here's another one. You had a breakout. Okay, so is that leadership? I guess. There's a breakout. With gold moving higher, you've seen names like Silver Wheaton coming back. You can go through pretty much all the gold names, and they all look the same. But a lot of them had pocket pivots. Newmont Mining had a pocket pivot on Wednesday. Silver Wheaton, which is my favorite. I don't know why. I just like the name. They're kind of all the same. It's half a dozen of one, 6 of the other. Had a pocket pivot. And yesterday we saw gold run into some resistance. But I think gold and the miners, you have to look at them on pullbacks. And like with anything in this market, you don't want to be chasing strength. Sort of a fool's game. So here's one. Since we use their system, we're using GoToWebinar by Citrix Systems. Here's one on the comeback trail. It's a little V-shaped. So, but I remember looking back at some of the really old model books. There were periods where you would see some quasi V-shaped cup with handle formations. I remember International Game Technology. Remember IGT? If you do your data yourself. Yeah, and that was one that had a somewhat V-shaped cup with handle, but it worked. So in a QE market, I know I point out V-shaped patterns as potentially being vulnerable, but vulnerability is as vulnerability does. Unless you see concrete signs of a stock breaking down from a V-shaped pattern on the daily chart, then guess what? It's still working. So, I've gotten out of the business, and maybe this comes with pushing on 26 years in the markets, of trying to have an opinion about what something should do, or getting myself all indignant over this or that, or what the central banks are doing, or what the country's doing, and the government getting into debt, blah, blah, blah. And it's all BS. It's all noise. And so I let the stocks tell me what they want to do, and you get to a point where you keep your mind completely empty, so to speak, and just let the real-time information filter through. It's like surfing. Surfers don't sit there in the water watching a big wave come in and saying, no, you're supposed to go out to sea. You're not supposed to be coming in. And you sit there and you try to tell the wave what to do, and well, you're obviously going to get pummeled, and you'll be pushed under the waves for maybe a few minutes, which is always fun for anybody who's been surfing. But you just find the wave, ride the wave until you can't ride it anymore. And by the same token, understand that there will come a point where the wave is going to break, and probably on some rocks, and you don't want to be staying on there too long. So there is a time to sell. Someone's throwing some symbols at me. Probably cheap little garbage stocks. 10-cent holdings. Yeah, that one's trying to break out. It's very thin, very small. But you're seeing some of these, like the Chinese names, doing okay. This looks like it's trying to come around. Alibaba. Trying to come around. What's this other one? HTHT. China Lodging, that's trying to come around. Looking at Kang also. It's, see now this is not an ugly duckling pattern. It's sitting in a big cup with handle. Maybe it's ready to break out. But you're seeing a lot of these names turning around. And so you can sit there and argue with it. Give me a second here, everybody. Looking at something here. Okay. Let's continue. Anybody else have some more stocks they want to talk about? Let's look at CRM. Okay, this is trying to come back. It looks wedgy into the 200-day, but now it's gone through the 200-day, and I think volume is probably going to pick up today. So you're actually in a position where you could see a pocket pivot. And you look at the other names in the group, data is one of them. To me, this looks like a bear flag. If you look at it on a weekly, it looks like it could roll over, but it also could turn and go higher if the market continues higher. Workday is another one. This one is forming a somewhat V-shaped pattern, but notice how this flag doesn't really look all that bad. As it's pushing sideways, it's hanging below the 10-day line and above the 20-day, but you're stuck in no man's land between the 50-day and the 200-day, and you're seeing selling volume steadily decline. So this may be setting up to move higher. And I actually played this when I tried to short it to the 50-day. I think I've talked about this before, but you know me, I like to beat a horse to death. I was trying to short at the 50-day, and I could feel that it wasn't giving up. There was no bid. Every time I would drop in a buck or so, and I think I was going to make some money, you could see the bid come in and push it back up. So I just flipped over and went heavy long, and the thing jacked, and it went a lot higher by the end of the day. And I'm glad I did that, because I would have probably gotten my head ripped off shorting the stock. Again, you can see what the thing is doing. Why argue with it? You know, if you think a wave is going in one direction and it turns out it's not, once you get on it, then you turn your board around. It's really not that hard to do. Yeah, I know, JT. I know you want to pitch your Intrex on, but it's another one. It's trying to come around, yeah, and that's true. Fidelity does have a pretty big position in it, but the other thing is, if it's not a big stock, I pay more attention to whether they're buying what would be considered a big stock. So this one, I think this has potential. I'm not going to say it doesn't, but it's a positive that they own it. And if they've been adding to it on the pullback, then they may have been some of this volume. So that's constructive. But you know, I prefer going for big stocks that are much more liquid. This one's reasonable. It trades 2,000,001. So, oh boy, here they come. Of course, they're going to start on this side of the house first. Let's see. Someone's asked about FireEye. This is another one trying to come around. But, you know, I think I'd go for Palo Alto Networks. It seems a little bit better. And that's the real leader. What about Tesla? Some of these. Now, here's another one. You know, this one. This is hilarious because so many people want to be so short this name, and I think they ran the last report, which would have been March 31st. The new one should be coming out like next week, next Tuesday, I think. It's usually 4 or 5 days after the report date. So if it's March 31st, you're going to see the data. I'm sorry, February 29th. You're going to see the data on like March 5th or something like that. I hope nobody can hear that. But they're actually drilling and cutting right next to me. And they just got here. So figures are going to start here first, right? While I'm in the middle of this. Anyways, but that's the way it works. EFSC, Enterprise Financial Service. This is forming a long base. Maybe it's okay. I don't know. It doesn't thrill me. That one look okay to you, Dr. K? Does it have great numbers?
EFSC. Let's check it out. Well, it's a thin name. It's a bank stock. Numbers are okay. Nothing impressive. Certainly wouldn't be considered as anything actionable.
The problem here is it trades 71,000 shares a day. So you're looking at stocks. In my view, you're looking at stocks that just don't trade enough volume. They're junky. So one of the signs of an institutional name is the volume. And so if I see something that looks interesting, but it trades 100,000 shares a day or 200,000 shares a day, I think my minimum is 350 in terms of number of shares, and we like to see 36 million in dollar volume or better. But you can fudge around that depending on the size of your account. But there's really no institutional interest in a name like this, and you can see it trades very volatile. Just sliding back and forth, and that's probably because there's no real institutions playing in the name. So you want to see the volume, average volume increase. That's one thing I look for in a name that I like or that looks interesting to me. I look like a good example would have been Crocs when it started trading back in 06 or 05, I forget. It was trading 200,000-300,000 shares a day, and then that, as it started to move a little higher, that started to increase very rapidly, and that told you that institutions were coming into this stock in a big way. So it was something to look at. So What numbers are you looking at? Institution volume, ROE. I'm not sure what you mean. I don't really look at numbers per se. I try to use my judgment and understand what their thematic drivers are. So for example, if you were a Can Slim cult member and you were looking at Tesla, even though the Ivy Dweebs will tell you that Tesla was a leader back in 20, when did it have that big move? 2012, where are we? Keep going, keep going, keep going. When was that, Dr. K? Was that 2011 or 2012?
Sorry, what's that?
Tesla had a huge move in when? 2012? No, 2011.
That was 2013. 2013 was its big move.
Okay. I'll get there. You know what? Let's just go to the weekly. Yeah, there's a move. Okay, this thing was losing money when it started. It had no return on equity because they weren't making any profits. So what I look at thematic basis for a move. In this case, we wrote articles on Tesla when it started its move. We wrote articles about it being an industry changing situation for the auto industry. Can anybody hear that? Can you guys hear that?
It sounds like a garage band performing next to you.
No, it's like they're drilling right above me. Jeez. Thanks, guys. Anyways, we'll deal with it. Whatever. These are the.
You're still coming in loud and clear, so your voice is much clearer.
That's fine. Okay, the microphone should help cancel some of that out. We hope. In any case, the whole world gets short the stock, and Tesla's going higher, but it looks great. And I wish I had bought it. I mean, I saw it coming up, and I thought this thing's probably going to go higher. It has. But look at how it just steadily moved higher. You could have bought these pullbacks in here, and it's just continuing higher. So let's see. Somebody says they can hear, but it's okay. Okay. Oh, I'm sorry. You asked Dr. K how the numbers look for EFSC. Okay, sorry about that. So what numbers were you looking at, Dr. K, on EFSC? Well, my number would be that it's not an institutional name. It's a junky little stock that trades 71,000 shares a day. And my advice would be that you need to stop looking at those types of names. I think that's amateur stuff, you know.
Yeah, it is way too thin. But as far as the fundamentals, I said they're okay. They're nothing winning. I mean, your sales are nothing winning. I look at pre-tax margin, return on equity, things like that, right? But I wouldn't look at those. I wouldn't go any further, just seeing how thin the stock is. So it wouldn't really hit my radar.
Yeah, it doesn't hit mine either because it's just too thin. But when I started working at O'Neill back in '97, I used to give Bill a lot of names that were these smaller, thinner names, and he used to give me a bad time about it. He said, "These aren't big stocks. You're too thin. You need to learn how to pick real stocks." And he used to get on my case and tell me that you should stick to stocks, 30, 40, 50, 60, 70, $80 or higher. The higher, the better. And so we actually talk about this in the book Falling Forward, where when I was a broker, I got caught up in a couple of names, like Lumisys was one, as I recall, where it traded 80,000 shares a day. And when that thing got in trouble, trying to get out of it was very difficult. But it's also a sign of a lack of institutional participation. So pretty charts are one thing, but you also have to take into consideration what is the thematic basis for a move, and our institutions in there, which indicates that they probably understand the thematic basis for such a move. So anyways, that's all. So it's okay. Let's see. Here's another one, Silver Spring. Now it's thin, yeah, another thinny, 294,000. But it looks good, So I don't know if there's. See, if I saw something like this and I understood the story, what I would like to see, and what might be an indication for me to want to participate, and I would say this is a little better for trading nearly 300,000 shares a day on average. So if you have a small account, you're going to buy 2,500 or 3,000 shares, and you're probably okay. In that case, you're 1% of the daily volume. But for the most part, you would like to see the volume. So I always watch this moving average of volume line, and on the weekly chart too. If it starts increasing significantly, that's usually a good sign. Let me see if I can show you guys Crocs. Should be able to. It's a long time ago, if anybody remembers. Let's see. When did it had its move? And it topped in 2007 with the market. It was October. But you can see here. This is what I'm talking about. You can see this low volume, the line is here, and then here's where it's, as it's starting to come out of this base, you start to see the moving average line. Let me see if I can make this bigger for you guys. You can see this moving average line start to move up sharply. You see how that increases all the way up? And it just keeps going higher right up into the top when it tops in October. So that's what I'll watch for, is an increase in average daily volume and the moving average lines on both the, which I use a 10-week on the weekly volume and a 50-day on the daily volume. So those are things you want to watch for. Okay, where were we? Well, you can see here's Avago, which is Broadcom now, so they merged. I like, that's a nice compromise. They take one company's name and the other one's symbol, so I think that's a marriage of equals there. But that's a breakout, and it's moving higher. You could call it a double bottom breakout through here. So you had the gap up and then the pullback. So you want to buy the weakness. The volume, the pullback comes on light volume, and zoom, it goes out of there. So that's working. You look at GoDaddy is another one I've been keeping an eye on. We were looking at this last week. This actually, okay, it's a little V-shaped, but notice how it's holding very tight. And if it closes around here this week, then you're getting tight action. Look at the volume at the end of the day and see if it remains light on a weekly and a daily basis. But so far, it is. And you can see that it's hanging tight and forming a cup with handle. You could call this a double bottom, I suppose. But it's a little bit funky looking. I'd call it more like a cup with handle. But beyond all that, rather than trying to put a label on it, see, and I thought the termites were bad. But anyways, it's holding tight along the 10 and 20-day lines, and you're not seeing selling volume pick up. It's drying up. So to me, this tells me that this thing wants to move higher. So a lot of people ask about fit, and this is probably the ugliest of the ugly ducklings. I maybe throw Twitter in there too. It's, I don't know, it's not really coming around. So it's like GoPro, you know, is another one, and that's not really coming around. Amberella is another one, and it's not coming around. So you know, a lot of these, they're not really. At this point, I think they should be well up off their loads. If they're not, then they're probably not going to work. Look at Twitter. Twitter tried to, almost got going. Got a pocket pivot here, and it's just not happening. Here's the one I like. I've talked about this one before. Energy recovery. These guys make these Vortec pumps for fracking, as well as pumps for desalinization plants. And a lot of people are talking about water being the next shortage or resource that'll be in shortage. And of course, we've seen names like AWK, which is a water utility, and Water Aqua America, WTR, hanging tight. But this one is an interesting play. I was telling Dr. K, this is the Plug Power of 2016. You guys remember Plug Power? I think it had a move from like 4 to 14 and went bonkers. Everybody wanted to jump in at 12, 13, 14. It was actually looking okay, and then it died a miserable death. But this one looks to me like it could head higher. And I think you are starting to see some institutions come into the stock initially. So it's an intriguing play, but it probably needs to take some time to base here. But I would keep an eye on this one. I think it's interesting. Let's see. LinkedIn, this one's trying to come out. This one looks more like a short. It looks like a big bear flag ready to break. Running through my watch list here. As far as the oils go, we looked at EOG. I'm sorry, EOG. There we go. Last week, it's moved up a little bit. Some of these are moving. Silica Holdings, we looked at a number of times, and this one started to get going. There is talk of buyouts starting to occur in the group now. Someone I know who understands the oil industry told me that a bottom in the industry would probably occur when you started to see consolidation, where things become so beaten down and so cheap that you start to see some oil companies gobbling up other ones. And if you start to see it, I don't think there's any real concrete evidence of that right now. There is talk of it now that's become more public, but I think that would cause or create a low. That would tell you you're at a point where values have become so low that they're probably ready to turn. So that's something to keep an eye on. And I've been watching a number of these. I think they've all had good moves. Fang, Diamondback, that's had a good move. So some of these are trying to come back. So I'd be watching for some ugly duckling patterns to show up in the group as an indication of them turning. So let's see. I think I've gone through a number of situations. I think it's a matter of just waiting for the right spot and being able and being willing to jump in on weakness and being opportunistic, almost in a shrewd fashion. You know, because we were talking about how with Solar Edge, yeah, it's not holding the moving averages here, but you might notice an undercut where then it closes near the peak of the range after the undercut, like this one did. The other one that did that we looked at was CyberArk. And that was an entry point in here. You might have caught that move if you were alert to that. I saw it. I didn't believe it. But the bottom line is, you know, if you see it and it looks like you can act on it, then go for it. The worst that can happen is, as long as you set a nearby stop, the worst that can happen is you end up with a small loss. So I don't think it's the end of the world. And I think in this market, that's really the only way you're going to gain any kind of an edge on anything. Trying to buy breakouts, they might work, but I think you're lagging. So in a lot of cases where you start to see breakouts, the stocks have probably already been moving up for quite a while. And we know that. I mean, SWHC, I think we've been talking about this one since it's been hanging along the 10-day, you know, some 20% lower. And now you have the breakout here. You do get some traction, and about 10% higher, roughly. And maybe that's all you get. But I think you get an early start and an edge by getting an early entry in the base. And I think that's what you want to focus on. So, now also another, I'm going to wrap it up here, another ugly duckling sort of play is Caterpillar, which is trying to round out a base, and it has had a pocket pivot coming up through the 10-day line or off the 10-day line here yesterday, and it's trying to turn around. Now, you have to ask yourself, how bad are things if Caterpillar is starting to act well, and how bad are things if building stocks are trying to turn and having pocket pivots? Here you see Lennar has a pocket pivot here, pulls back for 2 days, his volume dries up, and then it turns higher. And you look at DR Horton, for example. This one had a pocket pivot coming up through the 200-day, pulls back for 2 days. You could see this volume picked up a little bit, but that's more like support off the 200-day, given the narrow range and how tight it was and the fact that it closed higher than where it opened. I also like to keep on my daily charts, in lieu of candlesticks, the opening tick, which is the little tick here, and then the closing tick, because that gives you a sense of whether something found support on an intraday basis or not. And I think it's much better than just using a straight bar chart with only the close. So think about that. Could you discuss Amazon, how you recognize when it was not holding the 1020 and putting the 50? Well, I actually bought Amazon in the after hours on Wednesday. It got down to like 563, 564, and I looked at that and I thought, okay, that's right down to the 10-day line. So my thinking was, okay, if this thing doesn't hold the 10-day tomorrow, I'm just going to sell it. So it had a rally in the morning, and then I sold into the bounce because it just didn't look right to me. But if you look at the 620, at the very least, you could have seen, in fact, I think this is why I sold it. It just seemed to be flopping around early in the day. So it actually opened up, so I did end up making money on that. But I didn't buy very much. And immediately you got a 620 sell signal. So to me, you get a 620 sell signal, that's my signal to exit any long position. And then watching it break the 10-day line later in the day was another short signal. But you could combine that with the 620. But sometimes I'll just, if I'm long something and I feel like this is acting weak, then, and I sell it, I will look at going short it if I've got something that can guide me that way. And so because I was selling it into the strength early in the day, I mean, not really even strength, because it actually did open down, but it actually opened up from where I was buying it the night before, an after hours trade. And so, you know, once this happens, sell that and then go short here, and boom, it breaks. So, and I think with any of these ugly ducklings, this looked constructive, okay? But you might have noticed, it's very subtle here, I think. that selling volume was picking up in here, and on the rally back up above the 50-day, it really wasn't picking up as much. So maybe not as strong as you'd want it to be. So in that case, you know, it would push you out very quickly. But either way, you know, if you bought in at 570 and you're bailing out at 560, that's like buying a stock at 57 and selling it at 56, which is just 2% lower. So I wouldn't get caught up with the numbers, but now notice that it's undercutting this low, and I don't know if this sets up a buy opportunity, because this pullback or sell-off, I don't know if it's a sell-off so much as it's a pullback. It's coming on news that Apple has shifted some of their cloud activity to Google Cloud Platform from Amazon Web Services. So, and there is talk of other people, like Box, I think is another one. There's a couple other companies that are setting up their own independent networks or cloud networks, whatever, platforms, blah, blah, blah. So that's really, you know, on Amazon, I was long the stock. I bought the pullback or the drop in after-hours trade on that news. And then the next morning when it opened up, yeah, I made a couple bucks on it, but nothing really significant because it wasn't a big position. But I had already figured out in my head what would make me sell it and whether I would go short the name. So I didn't actually go short it, but I thought about it, but I was too busy looking at other things to go long yesterday, like Splunk, like Nvidia, like Facebook, like SolarEdge, like Mobileye. You know, those names are all acting pretty well. So I noticed that as we've been talking, you know, names like this are moving higher. So, you know, again, if you see the pullback, you see the 620 cross, it's fairly clean. You could try and buy into that. I wouldn't be surprised if you see this thing go back to the 200-day line and maybe go through it. So with the Fed printing money, you know, or continuing to keep interest rates low, Bank of Japan negative, Europe negative, and that situation remaining, it's a little bit like 1999 in the sense that all that liquidity back then. I remember people whining that the Fed was being irresponsible, you know, keeping rates so low in 1999, and a lot of old timers did not believe it because they had never seen anything like it before. And of course, the market today is something that we've never really seen before. But as somebody who's been in the markets for 26 years, as Dr. K has, we have to guard against this idea that the market has to play out like something we've seen before. And so, and I think Dr. K, you even wrote a decent piece the other day about how your experience can work against you sometimes because you know too much,
Yes.
you know, and you've seen.
Yes,
Go ahead.
I really like what the market can continue to teach us. As O'Neill used to say, he's always going to be a student of the markets, and that really rings true. So no matter how much experience you obtain throughout your trading careers, you can never fall back on your laurels, rest on your laurels, and say that you figured it out, because the market will always hand you something new and challenging. And that experience that you accrue over the years can indeed work against you. I saw that work against O'Neill actually a number of times in our discussions throughout the years working with him. Of course, what made him O'Neill at the time was that he would be able to shift gears on many of my approaches when they would show profit, because that was his bottom line: is, you know, are you making money? And that should, of course, be the ultimate arbiter: is, you know, what is your risk reward? How much risk do you need to take to make whatever reward you're making? And does it suit your trading personality? You know, that's absolutely key. Because if you don't have that equation, you're never going to be able to follow your strategy. You will second guess yourself, and when you need to take those critical trades, you're going to make up an excuse as to why you should avoid it. And again, experience can indeed work against you in that matter.
Yeah, and also in our second book, In the Trading Cockpit with the O'Neill Disciples, we actually talk about this phenomenon because we both observed during 1999. And I like to say that, you know, I made so much money in 1999 because I hadn't had that much experience, and I didn't live through the 70s and the 80s. But a lot of old timers were thinking back to those times and, you know, telling me that, oh, this isn't for real, and this is out of control, and the Fed's being irresponsible, and blah, 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 and they completely missed it. And you have to think about something, and that is, and I think this is very important from a psychological standpoint, I'm going to finish with this, is that you need to think about the periods that you started trading the markets. In other words, your formative years. Where did you grow up in the market? Was it in the 70s? Was it in the 80s? Was it in the 90s? And I remember when I was a broker, one of the first things they taught us as a basic sales principle is that if you talk to people who are in their 50s and 60s, and this is back in 1991, or no, 70s or 80s, older people like grandparents, they like bonds because they lived through the Depression and they only trust the government and government bonds. If you talk to people who are in their 40s, then they've grown up during the nifty 50 years of the 50s and 60s. So you want to sell them Gillette and Caterpillar and Pepsi and Coca-Cola and all those nifty 50 type names. So people in their minds, they will think what's going to work the best is what they've seen in the past. And so there's a bias based on your prior experience in terms of what you grew up with. So in our case, I grew up in the 90s, and that was a parabolic market. So my methods were very aggressive. In some cases, you might say hyper aggressive because the market in the 90s was very forgiving. If you took a loss, and I could take drawdowns of 30, 50%, even once 70%, I completely made that back up in like a month and a half. But that's because that particular environment was very forgiving, and it allowed you to do that. Now, you get into the new millennium, and particularly now, the market doesn't rocket right back like it used to back in the 90s. So you take a big hit, you're going to have some trouble coming back. And therefore, I've had to change my methods to finding lower risk ways of buying stocks. And if I do want to be aggressive, I need to find lower risk ways of handling those positions without giving them so much room. So I've had to change my method simply by recognizing my own bias, having started in the markets in the 1990s, which was a parabolic decade. So, if you think about it, if you think the market's going to be like the 1990s all your life, you're in for a world of hurt. So anyway, so think about that. Think about, when did I start in the markets? What was it like? What are the biases that I have internalized because of that? And how do I correct those and adapt to what's going on today? Anyways, that's all we've got for today. We've kind of gone over. Anyways, it's Friday. So, maybe I'll let the drill say goodbye. In any case, you guys, thanks for showing up, and we'll catch you next week. Have a great weekend.
So long, everyone.